Hello and welcome to Module 1 of Pepperstone's Intermediate Trading course, Price and Trend Analysis. The first section of this module focuses on candles and bars, and the important information they provide traders about the current price action. In this lesson, you will learn the types of charts that are available on most platforms, the components that make up the candles and bars, how to identify the most popular candlestick patterns, and how to interpret the closes on the bars. The first part of this lesson will focus on the types of charts that you will encounter on most trading platforms and how each of the different charts function. The first chart that you can see on the screen is known as a line chart and is commonly plotted using the closing prices of each of the period by default. You can change this in the settings to reflect the average price for the period or the opening price, but I find that it is often best to keep the default settings as they are, as this will be what the majority of traders will see. Line charts are very beneficial when you carry out your initial analysis, as a lot of the noise is removed, making the support and resistance zones as well as chart patterns clearer to see. The closing price that is plotted is relative to the time frame that you are on, so on a 1 hour chart, it will plot the close of each hour, and on a daily chart, it will plot the close of each day. The next chart that we can see here on the screen is called a candle chart, and is one of the most common charts available on nearly every trading platform. Each of the candles on the chart represents a period of the time frame of that chart. For example, if you're on a 15-minute chart, each candle represents a 15-minute period, and on a 1 hour chart, each candle represents 1 hour. It is important to understand which time frame that you are looking at, as the different time frames will look completely different when compared to each other, even though you are looking at the same trading instrument. As an example, the 5-minute chart on the Euro-USD currency pair will look completely different to the Euro-USD daily chart, even though both charts are being formed by the most current price information. The last of the charts that we will look at is a bar chart pictured on the screen. Again, each of the bars that you can see on the chart represents the period of the time frame that the chart is set to. Bars and candles are formed using the same information and form patterns that look identical when they are viewed side by side. Whether you are looking at a line chart, a candle chart, or a bar chart, all of the price information of the instrument that you are trading, such as currencies, commodities, futures, or stock, are represented in the same consistent way, meaning that you don't have to change your charting analysis style for whatever you choose to trade. Now we will have a look at candle and bar components. Candles and bars are made up of 4 important pieces of information: the open price, the close price, the highest point of the range, and the lowest point of the range. With this information, any candlestick or bar can be created, and each gives you important information about the price action during that period. As you can see on the example on the screen, the main body of the candle is contained within the open price and the closing price. If the closing price of the candle is higher than the opening price, then it is a bullish candle. And if the closing price of the candle is lower than the opening price, it is a bearish candle. Some of the most common color schemes used on candles are green for bullish candles and red for bearish candles. It is important to note that the colors you choose to make your bullish and bearish candles is for your information only and does not affect the main components of how the candle is formed. The area outside the main body of the candle represents the movement outside the open and the close of the period, and is often referred to as the upper shadow and the lower shadow. The size of this area reflects how much price action there was outside the open and the close of the period, and can often give you important information about how much volatility there was in that particular period. Just like the components of a candle, the same information is used to form a bar. The open price is always represented on the left-hand side with a little handle, and the close is represented with the same size handle on the right-hand side. The distance between the low of the bar and the high of the bar is called the range, and it is this distance that provides us the information you need to know about the price behavior for that particular period. One of the great things about bar charts when compared to candle charts is that you can identify a bullish bar or a bearish bar instantly by looking at where the handles opened and closed, and not rely on its color. Let's now explore some of the common candlestick patterns that you will encounter, and how you can go about interpreting them. There are hundreds of different types of candles, all with their unique names and purpose, but I like to stick to the most common and useful candles that have relevance to what I am trying to achieve. Remember, it doesn't matter what the name of the candle is, it is what the candle represents that is important. As long as you can interpret what the candle represents, the name or the colour becomes irrelevant. Long-range or short-range candles can be identified as a candle where the body of the candle makes up the majority of the range. As you can see in the example on the screen, the upper and the lower shadows only make up a small portion of the total range. A good way to take the ambiguity out of what constitutes a range candle is to apply a scale similar to the example on the screen. If the upper and lower shadows are less than 20% of the overall range, then this can be referred to as a long-range or a short-range candle. Now, the best way to determine if a candle you are analysing is a long-range or a short-range candle is by comparing it to the previous candles on the chart that you are looking at. It would be difficult to apply a scale to determine the length of candles because of different timeframes and trading instruments, but you can certainly compare them to the previous candles, which give you all the information that you need. For example, if you viewed the candles on the screen in isolation, you could not determine if they are long-range or short-range candles. But when you look at them as a group, it is easy to see that the candles on the right have only half the range of the candles on the left. Now, although the range candles give you important information about what price has done recently, the next group of candles provide important information about what the market may do next. The candles that we can see on the screen now are called hammer candles, and they can be used to identify a possible reversal of a downtrend. From what you already know about the candle makeup, you can see that the open of the hammer candle is close to the top of the range of the period, as is the close. It is what price does throughout the hammer candle that makes it significant. To explain the importance of the hammer candle, let's break down every stage. You know the market is in a downtrend by the fact that the recent candles have been bearish. At the start of the hammer candle, this trend looks set to continue, with the open being lower than the previous close, and the sellers pushing the price down, extending the range of the candle. Sometime throughout the period of this candle, the buyers have regained control, and by the end of the period, the candle has closed close to or at the high of the period. The price action in the hammer candle displays a significant shift in momentum, from sellers having control and pushing price lower, to buyers seizing control and completely reversing the actions of the sellers. Now, in isolation, a hammer candle is not so significant, but when it forms as part of a series of bearish candles, it may help signal a reversal in a downtrend. It is important to note that with a hammer candle, and with all candles and candle patterns, the larger the time frame, the more significant the signal. A hammer candle on a 5-minute chart wouldn't be regarded as important, but a hammer candle on a weekly chart is extremely significant, as it represents the selling and buying behaviour for an entire week. The candles that we can see here on the screen now are called shooting star candles, and they can be used to identify a possible reversal in an uptrend. The open of a shooting star candle is close to the low of the range of the period, and the close is at or very near the low of the period. To highlight the importance of this candle, let's again look at every stage of its formation. You know the market is in an uptrend by the fact that the recent candles have been bullish. And at the start of the shooting star candle, this trend looks set to continue, with the open being higher than the previous close, and the buyers pushing the price up, extending the range of the candle. Sometime throughout the period of this candle, the sellers have regained control, and by the end of the period, the candle has closed close to or on the low of the period. The price action in the shooting star candle has displayed a significant shift in momentum, from the buyers having control and pushing price higher, to the sellers seizing control and completely reversing the actions of the buyers. In isolation, a shooting star candle is not so significant, but when it forms after a series of bullish candles, it may help signal a reversal in an uptrend. To remove any ambiguity as to whether the candle is a hammer or a shooting star, we can apply a similar scale to the one we used earlier. For a candle to be a valid hammer, the open and the close must be above 80% of the total range of the candle. Similarly, for a candle to be a valid shooting star, the open and the close must be below 20% of the total range of the candle. The final group of candles we'll be looking at are the doji family, and they can be used to identify key turning points in a trending or range-bound market. The image on the screen shows the most important type of doji candles. The long-legged doji is a type of candlestick formation where the opening and the closing prices are close to being equal, despite a lot of price movement throughout the trading period. This often signals indecision about the future direction of price. The gravestone doji is a candlestick that forms when the opening and closing prices are close to being equal and occur at the low of the period. The long upper shadow indicates that the period's buying power was matched by the sellers, and is commonly interpreted to suggest that the direction of the trend may reverse. The dragonfly doji is a candlestick that forms when the opening and closing prices are equal and occur around at the high of the period. The long lower shadow indicates that the level of the buyers and sellers are nearing a balance, and that the direction of the trend may reverse. Levels are very rarely exact in the markets, so we can use a scale similar to what we used earlier to identify these types of important candles. A long-legged doji can be validated when the open and the close of the candle is between the 40% and 60% levels of the total range of the period. A gravestone doji can be validated when the open and the close of the candle is between 0 and 20% of the bottom of the total range of the period. And finally, a dragonfly doji can be validated when the open and the close of the candle is between the 80% and the 100% of the top of the total range of the period. Similar to candles, the opens and closes of bars provide certain information that can be used to help determine the dynamics between buyers and sellers. As the examples on the screen demonstrate, the relevance of the close price is directly related to where the opening price is on the range of the bar, and although they appear similar to some of the candle patterns, they display a different type of dynamic. In this session, we have looked at the types of charts available. We have seen that bars and candle charts are made up using the same information, and the line charts reflect only the closing prices. We have explored the components of the candles and bars, and we know that the candles and bars are made up of 4 important pieces of information: the open, the close, the high, and the low. We took a look at what candlesticks are actually trying to tell us, and each candlestick is giving us important information about the dynamics of buyers and sellers. And finally, we explored the important relationship between where the close price of a bar is compared to where it opens. This concludes section 1 of price and trend analysis. In the next section, we will delve deeper into trends and understand the importance of long-term and short-term price trends inside the price charts, and how to determine when these trends have changed. Hello and welcome back to Module 1 of Pepperstone's Intermediate Trading course, Price and Trend Analysis. I'm sure many of you have heard the adage, trend is your friend, but it is so much more than just a saying. When you trade with the prevailing trend in your favour, your entry points don't have to be as precise, and your take profit targets don't have to be as sharp as they would need to be when trading against the trend. This section focuses on the importance of understanding the short-term and long-term price trends inside the price chart, and how to determine when these trends have changed. In this lesson, you will learn how to identify short-term trends that form inside price, the trading conditions that do not cause a change of trend, how to identify long-term trends that form inside price, and how to identify a change of a long-term trend. Short-term trends are trends that form inside the price chart that use the most recent price action to determine their direction. A definition of a short-term uptrend is a sequence of bars that have higher highs and higher lows than the previous bar, as you can see on the example on the screen. Similarly, the definition of a short-term downtrend is a sequence of bars that have lower highs and lower lows than the previous bar. To remove any uncertainty as to whether you are seeing a short-term uptrend or a short-term downtrend in action, you can apply the following rules. Only a bar with a lower high and lower low reverses a short-term uptrend, and only a bar with a higher low and a higher high reverses the short-term downtrend. These 2 simple rules will ensure that you know which way the direction of the short-term trend is headed quickly and with a degree of certainty. There are some special conditions that do not cause a short-term change of trend. Firstly, we'll look at inside bars. There are three types of conditions that meet the criteria of an inside bar. Firstly, the entire range of the period fits inside the previous period. Secondly, the high of the period is equal to the top of the previous period and the low is higher than the previous low. And finally, the low of the period is equal to the low of the previous period and the high is lower than the previous high. The other types of bars that don't cause a change of trend are called outside bars, and there are three types of conditions that meet the criteria of an outside bar. Firstly, both the high and the low of the range are greater than the previous period. Secondly, the high of the range is equal to the high of the previous period, and the low is lower than the previous low. And finally, the low of the period is equal to the low of the previous period, and the high is higher than the previous high. These six conditions, along with higher highs and higher lows, and lower highs and lower lows, cover every possible bar condition, which makes determining the short-term trend an accurate process. The final step for determining a short-term trend involves labeling each change of trend that occurs with a P representing a peak and a T representing a trough. Short-term uptrends that are reversed are labelled with a P, and short-term downtrends that are reversed are labelled with a T. Applying this structure will display a series of peaks and troughs similar to what we see here on the screen. Now let's have a look at a real example to demonstrate how labelling the peaks and troughs would appear on a real chart. As the example shows, once they are labelled, the peaks and the troughs become very clear, and it's easy to determine the direction of the trend. Once the analysis is carried out on the short-term trend, the analysis can be taken a step further by identifying the long-term trend inside the price chart. The same analytical process used earlier to determine the direction of the short-term price trend is now applied to determine the direction of the long-term price trend. If there is a sequence of a trough, a higher peak, and a higher trough, this will define a long-term uptrend. And if there is a sequence of a trough, a lower peak, and a lower trough, this will define a long-term downtrend. This style of analysis makes it easier to identify the direction of a long-term trend in tricky markets, where price action is not so obvious. Although this type of analysis may seem a little confusing at first, once you put it into practice, the logic of how it works will quickly make sense to you. As you can see in the example, the price trends are a lot easier to see when they are broken down in this manner, and you can quickly determine the direction that the trade should be placed in. Now let's have a look at long-term trends in action. In theory, trends can be easy to identify, especially when there are lines drawn and evenly spaced as illustrated in the previous examples. The example we see now applies the theory to a real chart to show you how it will look in a real trading environment. Now just by looking at this chart, you can see that there is an uptrend, but the trends aren't always this easy to spot. So let's put into action the peaks and troughs method to explain how it can help determine trends. Firstly, you have a trough at the start of the chart marked with a T. You can then see the price reversal near the top of the peak, which is marked with a P. As you go through the stages of the short-term analysis, the peaks and the troughs begin to form, painting a pretty clear picture of what the trend is doing. Once all of the peaks and troughs have been labelled, it is easy to draw connector lines that link the troughs and peaks together. And as you can see on the image on the screen, even though you were looking at a real chart, identifying this trend is as easy as it was in the theoretical example earlier. Remember that the market is not always this clear in direction, so it is good practice to label the peaks and the troughs for the more challenging market conditions. In between all of the labelled peaks and troughs on the screen, you can see that the only time the trend reversed was when there was a candle with a higher high and a higher low, or a lower high and a lower low. Now let's have a look at a real example of how the theory works on a long-term downtrend. Once all of the peaks and troughs are marked out, it becomes easier to see which of the peaks and troughs are higher or lower than each other. You can now go through and label the peaks that are lower than the previous peaks with an LP, representing a lower peak, and you can mark the troughs that are lower than the previous troughs with an LT, representing a lower trough. Once this is completed, it is easy to draw connector lines that link the troughs and peaks together, and as you can see, even though you were looking at a real chart. Again, identifying this downtrend is as easy as it was in the theoretical examples earlier. You need to keep in mind that although this downtrend looks obvious, the market isn't always this clear. So it is good practice to apply this method to remove any uncertainty as to which way the trend is headed. Once the direction of the long-term trend has been identified, it is just as important to understand when the trend has changed. The example that we can see on the left of the screen now has a series of higher peaks and higher troughs. A change of trend occurs when price makes a lower peak and then continues down to make a lower trough. Once this sequence happens, the longer term uptrend has ended and the sequence that starts a long-term downtrend begins. The example on the right of the screen has a series of lower peaks and lower troughs, indicating a long-term downtrend. A change of trend occurs when price makes a higher trough and then continues up to make a higher peak. Once this sequence happens, the longer term price downtrend has ended and the sequence that starts a long-term uptrend begins. Now let's look at a real example of how a long-term uptrend can change. On the screen we can see that there are a series of higher peaks and higher troughs that are confirming a long-term uptrend. Closer to the end of the chart, there is a situation where price has formed a lower peak. This is the first signal that there may be a potential change of trend. Once price crosses below the previous higher trough, there is confirmation that the current long-term uptrend has come to an end, and the new sequence of a trough, a lower peak, and now a lower trough confirms the new long-term downtrend has commenced. The example we see now has a series of lower peaks and lower troughs that are confirming the market is in a long-term downtrend. Closer to the end of the chart, there is a situation where price has formed a higher trough. This is the first signal that there may be a potential change of trend. Once price crossed above the previous lower peak, there is confirmation that the current long-term downtrend has come to an end, and the new sequence of a peak, a higher trough, and now a higher peak confirms that the new long-term uptrend has commenced. You have now been able to establish the short and long-term trends inside the price chart without using a single external indicator, except the most important one, the leading indicator called price. It is important to note that this method works in any time frame exactly the same way, but remember that the larger the time frame, the more significant the trend. In this session, you have learned how to identify short-term trends that form inside of price. We have talked about the trading conditions that do not cause a change of trend on the short-term time frame. And we have learned how to identify long-term trends that form inside of price. And finally, we learned how to identify a change for long-term trend without using external indicators. This concludes section 2 of price and trend analysis. In the next section, we will look at multi-time frame chart analysis and explore how it can give you a broader view of the market conditions. We will look at some of the ways that we can analyze larger time frame candles by breaking them down into smaller time frames to help give a real insight about the dynamics of the buyers and sellers within each period. Hello and welcome back to Module 1 of Pepperstone's Intermediate Trading course, Price and Trend Analysis. In the third part of our Price and Trend Analysis series, we will look at multi-time frame chart analysis and how it can give you a broader view of the market conditions. We will look at some of the ways that we can analyze larger time frame candles by breaking them down into smaller time frames to help give a real insight about the dynamics of buyers and sellers within each period. In this lesson, you will learn how to interpret large time frame candles on smaller charts, how to understand the buyer and seller dynamics across different time frames, the importance of candle close confirmations, and how to interpret multi-time frame charts. Multi-time frame analysis is an integral part of any trading strategy, and it is important to understand the dynamics of each of the time frames you are looking at before making any trading decisions. What is seen on any particular time frame can look very different to the other time frames around it, so you need to be aware of what the larger and smaller time frames are telling you about the instrument that you're considering trading. The image that we can see on the screen is a daily candle. As you can see, it is a bullish candle, meaning that the open is lower than the close. You can see the high that the daily candle reached, as well as the low. But what is not apparent is the price action that caused this daily candle to form the way it did. Looking at this candle in isolation does not give any information in terms of how price moved throughout the day, and indeed if it finished strongly, or if it came off its high towards the end of the period. If you take it back one time frame to a 4-hour chart, you'll start to see a picture of how the daily trading unfolded. The one thing you do know for certain is the open of the day. The first 4-hour candle was a bullish one, as was the second. Now, depending on where your broker servers are based, the start of the day may have coincided with the Asian trading session open, so you know the entire session was bullish. However, the beginning of the London and European Open saw a shift in buyer and seller dynamics, which forced the price down to the lows of the day. A trader who entered the market looking at the current day's movement would likely have thought the bullish behaviour was set to continue, and any long trade would have seen a reasonable retrace in the next few hours of trading. During the fourth 4-hour candle, the buyers took over the trend direction quite aggressively, and reversed the negative sentiment to close the London trading session at a new daily high. The first part of the New York session continued the bullish advance, moving closer to the high of the day, before retreating in the second part of the trading session, as you can see with the last bearish short-range candle. The information from the smaller time frame provides insight as to which of the trading sessions were the strongest, and how the end of the day played out. The importance of the daily time frame cannot be underestimated, as it gives a holistic view of the entire world sentiment towards that particular trading instrument. Let's now break down a 4-hour candle and reconstruct the price action that happened one time frame lower on the hourly chart in the example on the screen. Again, the only thing we know for certain is the open of the 4-hour candle. The first 1-hour candle was a bullish one, followed by a bearish long-range candle. The third candle in the 1-hour time frame completely reversed the temporary negative sentiment and extended to reach a new high for the 4-hour period. Now, the last 1-hour candle was still bullish, but you can see that once the high of the period was reached, price retraced almost a third of the candle's total range, which indicates some weakness. If you looked at the 4-hour candle in isolation, this weakness is not so obvious, and you could be led to believe that the long-range bullish candle finished with the same momentum as it started with. Now, this information may not seem significant to longer-term traders who enter and stay in trades for days or weeks at a time. But for swing traders and scalping traders who trade intraday or on smaller time frames, this information is invaluable to determine the current strengths or weaknesses in the current price momentum. Now let's take a look and see what happens when we drop back 2 time frames to a 15-minute chart to understand the different buyer and seller dynamics. As you can see in the example on the screen, the 4-hour candle is showing a very clear shooting star, so you know immediately that prices close close to or on the low. What isn't so apparent is how a trader would have fared had they been trading the short-term price action throughout that period. As the 15-minute candles are starting to form, the first 2 hours of this candle provided some good long opportunities, with a series of long-range bullish candles forming in sequence. A trader looking at the 4-hour candle in isolation would not have seen this price movement, and may not have had a clear understanding of how the price dynamics changed throughout the period. On the 15-minute chart, we can see very clearly that the last 6 15-minute candles are mainly bearish, with the final candle retreating nearly half of the 4 hours total range. This information is invaluable to traders, as the price action in the first half of the shooting star was clearly in an uptrend, and if this shooting star formed at the top of an uptrend or at a resistance zone, it added more evidence that the newly established bearish momentum is likely to continue. Given the price movements you have just seen on the smaller time frames, it should be obvious to why waiting for the confirmation of a close of a candle is vital before making any trading decisions. The daily candle that we can see on the screen highlights the importance of close confirmation. As you can see, at the close of the Asian market, this daily candle appears to be a bullish long-range bar, usually indicating a healthy looking uptrend. Any traders who look at this daily candle without a confirmed close may act on that information they are seeing, and trade long with the anticipation that this candle will reflect the entire period. Now, if this candle did close as it looks here, this would be a reasonable expectation. The London and European markets have pushed the candle down to around the midpoint of the Asian market's range by the time they both closed. Now, although this candle is still reflecting a bullish candle, it is not as convincing as it was at the end of the Asian market close. Again, any trader entering on the current available information is still taking a chance that the candle will look very different when it closes. The last candle we can see here on the right shows what the candle looked like when it did finally close at the end of the US trading day. The same candle that looked like a bullish long-range candle is now a very bearish looking shooting star. Now, traders who jumped the gun and traded the bullish long-range candle early will already be incurring losses. But more importantly, shooting star candles generally signal a reversal in trend, so the chances of these trades turning profitable is reduced significantly. In fact, traders who waited for the confirmation close would be looking at entering short positions in the near term. Now let's take a look at multi-timeframe chart analysis. As with multi-timeframe analysis on candles, analyzing charts in the same manner can give you valuable insight into where price may be heading. Looking at this 6-week example on the weekly chart on the screen, you can see a series of indecision candles following a solid downtrend. Although important, this information does not provide any insight as to when it might be a good time to enter a long position, or indeed if a long position is valid. When you look at the daily chart for the same period highlighted in the blue box, you can see that there were 2 larger indecision candles, one of which meets the criteria for a hammer, after a series of bearish candles. Let's now take a look at the same 6-week period and see what it looks like on a 4-hour chart. Again, the price for the 6-week period is contained inside the blue box, and now you can clearly see a double bottom where the previous indecision candles were on the larger time frames. Finally, let's look at the same 6-week period on a 1-hour chart depicted in the blue box. The same double bottom is even clearer to see now, but more importantly, you can see a sequence of a trough, a peak, a higher trough, and a higher peak, which gives you the signal that the longer term trend on the 1-hour chart has moved from a downtrend to an uptrend. This multi-timeframe chart analysis, although relatively basic, has provided an entry point to trade the indecision candles on the weekly chart, with some clarity as to what the price action may be doing next. In this lesson, we have covered how to interpret larger timeframe candles on smaller timeframe charts. We have looked at how to understand the buyer and seller dynamics across different timeframes. We have understood the importance of why you need to wait for candle close confirmations before placing any trades. And finally, we talked about understanding the importance of multi-timeframe chart analysis and trying to interpret what the chart is displaying. This concludes section 3 of price and trend analysis. In the next section, we will look at some of the most popular candlestick patterns used by traders, including the engulfing patterns, star patterns, and the Harami patterns. This section will focus on the theory as to why these patterns form, and also how to identify them in moving markets. Hello and welcome back to Module 1 of Pepperstone's intermediate trading course, Price and Trend Analysis. In the final part of the Price and Trend Analysis series, we're going to look at some of the most popular candlestick patterns used by traders, including the engulfing patterns, star patterns, and Harami patterns. This section focuses on the theory of why these patterns form, and also how to identify them in moving markets. In this lesson, you will learn how to interpret and trade engulfing candlestick patterns, how to interpret and trade star candlestick patterns, how to interpret and trade Harami candlestick patterns, and how to trade reversal candlestick patterns in the direction of the trend. If you look up candlestick patterns in a Google search engine, you will be provided with literally hundreds of pages of information related to technical analysis trading patterns, and probably the same amount of results for different named patterns and functions. Not to be confused with chart patterns such as double tops and bottoms and head and shoulders patterns. Candlestick patterns usually consist of 2 or 3 candles that form in a particular sequence on a candle chart. Despite the fancy names that many of these patterns have, the reality is that the name of the candle is irrelevant as long as you understand what the pattern represents from a price point perspective. In my experience, candle patterns traded in isolation aren't nearly as strong as when they are traded with other supporting evidence, such as support and resistance zones, or as part of a larger chart pattern. When candlestick patterns are traded as part of a bigger picture, they are extremely valuable to not only give a trader quality entry points and exit points, but also to confirm key reversal zones. This lesson will focus on engulfing patterns, star patterns, and harami patterns. All three of these patterns are reversal patterns, and there are countless reversal and continuation patterns out there, but I have found these to be the most consistent and useful to my trading techniques. The first patterns we will look at are the engulfing group of patterns. There are two types of engulfing candle patterns, a bullish engulfing pattern and a bearish engulfing pattern. Engulfing patterns generally form at the tops and bottoms of markets and indicate a level of directional control reversal by buyers in a downtrending market and by sellers in an uptrending market. A bullish engulfing pattern forms after a series of bearish candles in a downtrend. The first part of a bullish engulfing candle will look set to continue the negative advance, and it generally looks like a bearish long-range candle. The second part of the bullish engulfing pattern is a bullish long-range candle whose body completely engulfs the previous bearish candle's body, as you can see on the example on the screen. A bearish engulfing pattern forms after a series of bullish candles in an uptrend. The first part of a bearish engulfing candle will look set to continue the positive advance, and it generally looks like a bullish long-range candle. The second part of the bearish engulfing pattern is a bearish long-range candle whose body completely engulfs the previous bullish candle's body, as you can see on the screen. In this example on the Euro-USD weekly chart, there is a series of bearish candles forming. At the bottom of the trough, the bullish engulfing pattern forms, where the body of the bearish candle has been completely engulfed by the bullish long-range candle. As you can see, the current trend has been reversed by this engulfing pattern, which started an uptrend that lasted 7 months. At the top of this trend, there is another example of an engulfing pattern, this time a bearish one. You can see a series of bullish candles advance, with the last candle's body completely engulfed by the bearish long-range candle. This pattern again halted the uptrend and started a downtrend that lasted 2 months before another bullish engulfing candle pattern formed. Now on this chart alone, there are 3 examples of how engulfing patterns can reverse a trend, but it is important to keep in mind that where the engulfing pattern forms and the price action around it is what's important to increase the chances of the success of this pattern. An engulfing formation in a range-bound or directionless market does not provide useful information, simply because there are no trends to reverse. The next candle patterns we will look at are the morning and evening stars. Morning and evening star patterns are also reversal patterns, and are made up of 3 candles. Let's break down each of these patterns to find out what they are trying to tell us about the market movement. A morning star pattern is a bullish reversal pattern often found at the bottom of downtrends. The first candle is a bearish long-range candle that generally continues the seller's momentum after a series of bearish candles. The second candle starts out in a similar fashion, often gapping lower on the open, with the sellers extending the downward advance for part of the period. However, at some point throughout the period, the buyers seize control from the sellers and push price to the highs of the period, and it subsequently closes around the initial open. The final candle in the morning star pattern is a bullish long-range candle, similar in size to the bearish long-range candle that started the pattern. An evening star is a bearish reversal pattern that is often found at the top of an uptrend. The first candle is a bullish long-range candle that generally continues the buyer's advance after a series of bullish candles. The second candle starts out bullish, often gapping high on the open, with buyers pushing the price higher for part of the period. At some point throughout the period, the sellers wrestle control from the buyers and push price to the lows of the period, and close the candle around the same level as the open. The final candle in the evening star pattern is a bearish long-range candle, similar in size to the bullish long-range candle that started the pattern. Now what makes the morning and evening star patterns important are the buyer and seller dynamics that they represent, and there are 2 main reasons for this. Firstly, the failure of the middle candle to continue the advance in the trend direction, and the fact that it closed near the open of the period, gives the first sign that the recent trend has shown weakness in its advance. Secondly, The final candle in the formation completely reverses any gap formed by the middle candle, and generally wipes out any gain made by the first long-range candle. This is a signal that the opposing forces in the recent trend, the buyers for a morning star and the sellers for an evening star, have taken advantage of the weakness in the trend and assumed complete control of the price movement. Now let's have a look at a star pattern in action. The example on the screen shows a morning star pattern on the ASX 200 index on a weekly chart. As you can see, the trend at the start of the chart is bearish, with a series of red candles pushing price lower. The first candle in the blue box continues this trend, with a bearish long-range candle. The middle candle shows that at one point in the week, it replicated nearly the entire length of the previous candle, so the selling pressure seemed set to continue. At some point throughout the week, the buyers assumed control and pushed price to near the highs of the week, closing above the open. The final candle in the blue box is a bullish long-range candle, and as you can see, its range was nearly twice as long as the first bearish long-range candle that formed at the start of the pattern. The example on the right is an evening star pattern, again on the ASX 200 index, but this time on a daily chart. The trend at the start of the chart is bullish, with a series of green candles pushing price higher. The first candle in the blue box continues this trend, with a bullish long-range candle. The middle candle shows that the buyers had full control as the candle extended higher, and the uptrend looks set to continue. At some point throughout the day, the sellers took control from the buyers and pushed price to near the lows of the day and closed below the open. The final candle in the blue box is a bearish long-range candle, the one required to complete the pattern, and as you can see, its range is greater than the first long-range candle that formed at the start of the pattern. Now in both of these examples, the price did not gap on the open of the middle candles in the pattern, but this is not a necessity for the morning or evening star to be valid. What is essential is the price action and the trend direction prior to the formation. It is important to note that the larger the time frame that these patterns appear on, the greater the significance of the pattern. You can see in the example on the left that because the morning star formed on a weekly chart, the pattern took 3 weeks to complete and succeeded in reversing a very strong downtrend. Now we'll take a look at the Harami patterns. A bullish Harami pattern forms after a series of bearish candles in a downtrend. The first part of the bullish Harami pattern will be a bearish long-range candle, as can be seen in the example on the screen. The open of the next candle gaps up above the close of the bearish range candle and fails to make a new low for the period. The entire trading range of the second candle is contained within the body of the bearish range candle. A bearish Harami pattern forms after a series of bullish candles in an uptrend. The first part of the bearish Harami pattern will be a bullish range candle, as you can see on the screen. The open of the next candle gaps down below the close of the bullish range candle and fails to make a new high for the period. The entire trading range of the second candle is contained within the body of the bullish range candle. The most important information that you can take out from a bullish and bearish Harami pattern is that there is a price gap that occurs at the open of the second candle against the current trend, which in itself is a warning to be alert for a possible reversal. The fact that the second candle failed to make a new high in an uptrend or a new low in a downtrend confirms that the reversal of the most recent trend is likely. Let's look at some real examples of bullish and bearish Harami patterns in action to demonstrate how useful they can be. The example on the left shows a downtrend in action, with a series of large bearish candles in sequence on the Aussie USD 4-hour chart. The second candle inside the blue box gapped a little higher than the close of the previous candle on its open, and traded within the range of the previous candle for the 4-hour period. What followed was a reversal of an aggressive downtrend, with a large bullish range candle that engulfed nearly 2 of the large bearish candles prior to the Harami pattern forming. The example on the right shows a bearish Harami pattern on the Aussie USD daily chart. This chart shows an uptrend in action, with 2 large bullish range candles in sequence. You can see in the blue square that after the close of the last bullish range candle, the next candle gapped down and opened a little lower, and traded the entire day inside the range of the last bullish candle. What follows is a large bearish long range candle that begins the reversal of the current uptrend. Although the gaps on the open of the second candle in the Harami patterns aren't large, you have to be mindful that the examples are on the 4-hour and daily chart. Because the Aussie USD operates in a 24-hour, 5-day-a-week market, it is rare to see large opening gaps on larger timeframe charts during normal market hours. Harami patterns found on smaller timeframes often have larger gaps, due to the fact that they are more susceptible to sharper market movements that occur around the open and closes of key global market sessions. As I mentioned earlier, there are hundreds of different candlestick names and patterns around, with some being reversal patterns and others being continuation patterns. The patterns that we have focused on in this section best fit the style of the trading that this course is built on, and complement the other trading tools throughout each module. Although all of the patterns discussed represent the reversal group of candle patterns, you can still use them to trade in the direction of the prevailing trend. In the example on the screen, we can see that the prevailing trend is clearly long, but some of the reversal patterns that we have focused on in this section have played a part in signalling the trend continuation. In the first example, the morning star pattern in the blue box is reversing a counter trend inside the main prevailing trend. And in the second example, the bullish engulfing pattern in the blue box on the right is again signalling a counter trend reversal in the direction of the main prevailing trend. As a trader, you don't have to try to pick the absolute bottoms and tops of markets. If you focus on the bigger picture and bring together the elements that complement what you are trying to achieve, you will see a big improvement in your consistency and your understanding of the market's behavior. In this session, we have learned how to interpret and identify engulfing candlestick patterns. We have learned how to locate and trade star candlestick patterns. We have learned how to locate and trade Harami candlestick patterns. And we have learned how to trade reversal candlestick patterns in the direction of the prevailing trend. This concludes Module 1 of Pepperstone's intermediate trading course, Price and Trend Analysis. In the next module, Charting Techniques, you will learn tools that you can use in any type of market and trading condition, which will give you the ability to apply your learning to your favorite trading instruments and timeframes.